95% of AI projects fail, yet capital keeps pouring in as if the future were already signed on a contract nobody's notarized. That's not a paradox, it's how infrastructure overhauls work. Whoever owns the pipes collects the tolls. In the digital era, the pipes are compute, data, and the ability to turn today's failed experiments into tomorrow's margins. From drive-thrus where a drink order gets misheard into something no one asked for, to boardrooms where auto notes still hallucinate 5 to 20% and force humans to recheck every line, we see the noisy surface of failure. Behind that noise lives the economics of computation, a learning loop that pushes inference costs down over time, a capital shift into unglamorous but durable infrastructure, and a disciplined rollout playbook that turns AI from slogan into real productivity. If you only follow the media, you'll conclude AI isn't good enough. The splashiest examples are in environments that demand near-perfect accuracy, ultra-low latency, messy vocabularies, and chaotic context. The common thread behind the failures: rushed deployments, missing control layers, no final human approver, no baseline KPIs for before and after, and no breaks, access controls, immutable logs, or rate limits. Step out of the noise and into repeatable enterprise workflows, low risk, highly standardized, clean data, and AI scales humans naturally. One employee can do the work of 2 or 3 with standardized drafts, contract checks against a checklist, test suite generation for code, and natural language querying of internal data to cut decision time dramatically. These wins aren't flashy, they're not viral, but they make steady, measurable cash. So why does capital still surge while the failure rate is high? Because investors don't buy headlines, they buy options on the future. In a world where compute capacity is a strategic commodity, owning data center clusters, reliable power, stable networks, and a secured GPU/ASIC supply chain means owning the pipes for the coming agent economy. Every 1,000 tokens of inference keeps getting cheaper, thanks to model compilers, batching, caching, quantization, distillation, and long-term compute contracts that lock pricing. As marginal costs fall, pricing can flex, product bundles proliferate, gross margins improve, and the learning loop spins faster. More users create more feedback, raise quality, attract more users, repeat. Capital flows to fast loops and to layers with moats: scale, hard-to-copy data, deep workflow integration, and contract durations long enough for time to work in your favor. Picture the value stack in 3 layers. Bottom, silicon and infrastructure, heavy capex, long cash cycles, quiet toll booths of the compute age. Middle, model platforms and APIs, durable take rates, once developer ecosystems and agent tooling mature. Top, vertical apps, great gross profit if the problem is narrow, data is clean, and integration is tight. Money doesn't flow evenly. It finds the bottleneck. Control compute and you're the pipe. Control proprietary data and integration and you're the gate. Sit on generic apps with no edge and you're in the most crowded neighborhood with the thinnest margins. None of this erases core risks. Hallucinations are real. In domains that cannot tolerate error, healthcare, finance, legal, security, AI can't freestyle. It must live inside a permissions architecture, least privilege access, uneditable audit trails, rate and volume limits, and human in the loop exactly where risk peaks. Pair technical breaks with process breaks, who approves, response deadlines, and escape hatches when things drift. And with financial breaks, per task spend caps that auto-scale down when unit costs spike. Without breaks, optimization is luck. With breaks, the same model becomes a trustworthy copilot. If you're an operator, your 12 to 24-month playbook is simple. Pick 1 or 2 high-repeat, low-risk workflows with measurable outputs. Lock your baseline for time, cost, and quality. Run strict A/Bs for 8 to 12 weeks with clear success criteria. If you hit the bar, scale with discipline. If you don't, stop, clean data, standardize schemas, clarify ownership and lineage, then try again. Don't build everything unless you have a real edge. Partner with deep vendors. Focus internally on integration and data governance wins far more often than panic hiring a few engineers to do it all. Hire the right new roles: AI operator for pipelines, a prompt designer who knows the business, an independent evaluator for quality. Standardize approval checklists. Train a trust but verify habit with a human holding the final red line. If you're an investor, ignore the surface noise. Read the curve of inference unit costs over time, contract structures, total power and supporting infrastructure commitments, depth of workflow integration, and how distinctive the data moat is. AI-first companies will still pivot. Infrastructure providers with long contracts attract capital even in a bear case. In the base case, modest cost declines per 1,000 tokens let narrow use cases spread. AI-assisted workflows become standard. Capital gets choosier but doesn't stop. In the bull case, step change cost drops plus mature agent tooling, AI software revenues accelerate. A few platforms and verticals turn into real money printers. Even then, durable profits accrue to those with clear moats, not to slogans. At the societal layer, admit a truth: public emotion outruns learning curves. Goofy real-world failures breed cynicism, while quiet productivity gains are nearly invisible. Leaders either give up too early or scale too fast. Both are dangerous. The sustainable path is a learning system. Each deployment is a guarded experiment. Capture data, adjust models, update processes, expand stepwise based on results. Once your learning system spins smoothly, it drives failure rates down and success rates up, enough to persuade even the skeptics. Put the pieces together and the opening paradox dissolves. 95% failure doesn't mean AI is a useless bubble. It mostly means organizations are deploying in the wrong places, the wrong ways, at the wrong pace. While capital is betting on pipes and cost inflection points that never make the headlines. Money still flows because marginal costs trend down, scale widens the moat, data and integration raise switching costs, and the successful 5% can swallow everything else through non-linear effects. That's how every great infrastructure wave has worked: noise first, value later, and the disciplined win. So if you want to be on the winning side, don't sprinkle AI everywhere to look modern. Think like a pipe builder. Clean the data site first, design breaks first, measure first, pilot narrowly, learn deeply, then expand. Keep humans in the right decision seats. Today's best AI multiplies people. It doesn't replace them. And remember, systems with clear logs, least privilege access, and per-task cost limits are always safer and more profitable than systems that run on hope. 95% failure, then, isn't a death sentence for the tech. It's a sober memo about how we organize, deploy, and govern. Who learns faster, cleaner, and with more discipline wins. Capital, as always, will keep flowing toward the pipes, the moats, and the people who can turn technical improvement into beautiful unit economics. If you found this useful, share it so more people see it. Subscribe and turn on notifications for the Billionaire Investment channel so you don't miss our next deep dives on AI investing.